All right, we're recording. Our last session, certainly not the least session, but our last session of the 2026 Advisor Network Virtual Connect is now underway. Um, I'm excited for what we've done over the last 2 days. I'd like to thank all of you who have been a part of our live event with this, who have attended the individual sessions. For the folks who have not yet attended a session, and this is your first, welcome. If you are watching this recorded, welcome. Over 7,000 of you are in our wealth management professional overall community. That number started 19 months ago at zero, so we're incredibly thankful for the growth that we've had and the number of you that have decided to join us within the Advisor Network. Of that group, 250 of you have joined the interactive collaborative platform itself. That's awesome. That gives you the chance to actually communicate one with each other and get our materials from our institutional partners. If you were just on the study group that we just hosted, awesome collaboration. It's just so fun to see advisors sharing what they're good at, exchanging notes, sending emails to each other afterwards, exchanging information. That's a lot of what this is about. But it's about both the advisor to advisor interaction and our thought leadership from institutional partners. We're about to hear from First Trust in just a few minutes from Bryce Gill and just doing just that. And so what's coming up today, we're about to end our virtual connect after this session. But if you want to join us in the Northeast, we'll be in Saratoga Springs on August 11th and 12th. In person, an opportunity in a small room, collaborate, and great content as well. The same thing in October 8th, a 1 day in Orange County, beautiful part of the world. And then our flagship event, November 10th, half day, 11th, full day, 12th, half day in Las Vegas is we call it flagship. It's a larger yet intimate event where we have the ability to bring together a group of advisors to share their best practices and thinking, but learn from folks like Bryce Gill of First Trust and others during that event. So, Bryce, I'm not making you come to Las Vegas, but I did just say your name with that too. So, we'll not put you under the gun for that, but we would always like to welcome you in the future if that's ever something you'd like to join us for. So, Bryce, First Trust, you guys are an amazing organization. You have a lot of free thinkers. I'm catching you on a day where 30-ish minutes ago we had a Fed announcement. So the timing couldn't be better for us to talk to an economist about the markets and your general thoughts around the world.
Yeah, well, absolutely. Thank you, Colin, for having me. It's great to be with everybody on the call today. Thanks for letting me be a part of this. It's great to be here. It's always kind of a challenge, right? When you've got a small window of time, and it's like, hey, give us an update on the U.S. economy and the markets and
Yeah.
everything going on in the world. And I guess like really bigger picture, like since COVID, things have gotten more and more chaotic. There's been kind of more and more things going on around the world, and all of us as investors sort of have to consider all these extraneous factors that really, from like the fall of the Soviet Union to I guess the COVID pandemic, were not really top of mind, right? So I'm going to do my best to try to sum it all up and kind of wrap it all up in a bow for everybody. But I understand we're going to have Q&A at the end. So guys, there's no way I'll cover everything, and feel free to bring up whatever's top of mind during Q&A. I can't guarantee I'll have an answer for everything, right? But I'm happy to do my best to give you one. But big picture, guys, okay. Um, I guess I'll talk about it in terms of like the last 18 months for a second. All right. When we think about the last 18 months, what sort of strikes me as an economist is like we've had these major shocks to the economy over and over and over and over again. And the US economy is just like basically shaking all of this off. Okay. So what am I referring to? Biggest shift in immigration policy in like 65 years. Okay. Then we have the biggest shift in trade policy in like 85 years with all the tariffs. And that's obviously an ongoing situation. Last year, the job market in the United States basically stalls out entirely, goes from adding about 150,000 jobs a month in 2024 down to like, I think it was like 9,000 jobs a month on average in 2025. So huge deceleration. And now we're capping it all off with, from what I can tell, basically the biggest global energy shock we've ever seen with Strait of Hormuz and Bab el Mandeb Strait and Russia sanctions and all this other stuff, Ukraine hitting Russian oil refineries. We're talking like 30% of global energy has basically been pulled off the market, right? So there's a lot of things happening at once. And despite this, the US continues to grow. So how is it that we've been so resilient? How have we shaken all this off? That's sort of what I want to address today, because I think when we get down in the details of why things have, we basically have shaken it off in the past, it gives you kind of an idea what to expect, I guess, going forward as well, especially when we're talking about a very complex, large economy like the United States that's tied in with the rest of the world. So with that, Colin, I'll go ahead and throw up some slides here, and just let me know verbally. I want to make sure they're showing up on your end.
We're good.
Okay, awesome. So, guys, I guess in my opinion, the reason why the United States, really simply put, has been growing despite all of this is we have a couple things going on. We have one, the biggest capex boom in probably like 80 plus years happening. And two, we have a huge shift in consumer demographics that have essentially changed the importance of the labor market when it comes to consumer spending. So I'll get into that at the end, but I want to start with the capex boom, okay? And there's sort of two components. One is like the reindustrialization of America post COVID, and the other is the AI capex boom. So I'll sort of take those one at a time here quickly, but I want to say big picture first. All right, from about 1990 to 2020, the United States embarked on like the largest boom in globalization in history. Okay. We were outsourcing supply chains, we were moving everything to other countries. I think we did this for a couple of reasons. One is it's just really profitable, right? You move your factory from Ohio to China, you cut your labor costs by 90%. It's going to be good for your profits as a business. But number two is we just didn't really think there was anything to worry about, right? Like the Soviet Union had collapsed. There was no other geopolitical competitor really. And so we felt comfortable building like this global trading system that was really efficient, but it was really fragile. And so that worked for a good while, right? Up until we have this global pandemic. And then we really see how fragile all these supply chains really are. And so in a very short period of time, everything sort of fell apart. We had the worst supply chain crisis, in my opinion, since the OPEC oil embargo. And so, in the aftermath of that COVID shock to supply chains, what's basically happened is a giant bipartisan push to bring back production in critical industries to the United States. Okay, so what I did up here on this chart, I pulled all this data from the US Census Bureau. This just shows manufacturing construction spending over time. So, what are we spending in the United States to build factories is an easy way to think about it. And so like 1990 to 2020, basically nothing happens with factory construction. It's sort of like a flat line. It rises a little bit, but keep in mind this is all nominal dollars, right? So adjusted for inflation, that line really was flat for like 30 years. Well, then we get out of COVID. In the course of like, I guess you'd say like 2 years, manufacturing construction spending in the United States basically tripled. It was the biggest factory construction boom probably since World War II. And that was in response to these supply chain issues, right? We want to make more pharmaceuticals at home, or defense goods at home, or solar panels and windmills, or semiconductors, or whatever. And so COVID sets off this giant capex boom in the United States. For 30 years, if you did physical plant and equipment investment, you did it somewhere else. Well, now we're making up for like this 30-year backlog, right? So one thing that's driven the US economy, and I'll get into the AI spending in a second because that's the biggest share here, but one of the things that's been driving the US economy really since reopening in 2022 has been this emerging capex boom in the country. And I think it's going to continue for the foreseeable future. Now, the trade-off to all of this is like globalization and cheap labor, really like a giant labor arbitrage. That's why I think we had 2% inflation for 30 years, right? When we talk about like Paul Volcker and, he crushed inflation with high interest rates. And then we give like Alan Greenspan credit for this like great moderation period. I really think it was globalization that gave us this lower than normal inflation rate. And so, hey, we're going to bring everything back home and pay Americans to do it. It's obviously going to be more expensive, right? Especially if we crack down on illegal immigration. And so, we have this whole energy shock going on. We all expect that to raise inflation. I think inflation is going to be high through the end of the year. I think, frankly, we're going to probably have some upside surprises to inflation. I don't think like the market price of a barrel of crude oil is $85 a barrel or whatever it is today, right? By the way, just for context on that, When Russia invaded Ukraine, okay, we sanctioned their oil off the market. So like 10% of global energy was removed from the West, right? When that happened, we had this big inflation surge, right? This is when the Fed famously called it transitory. Um, Oil went to $140 a barrel when 10% of energy was removed from the market. Today, we have about 30% of energy removed from the market, and we're like $85 a barrel for WTI. I think something's wrong with these spot energy prices. But leaving that aside, okay, we're going to have high inflation going forward. I think the Fed is not able to come to the rescue anymore, right? So at the end of the day, here, guys, more self sufficiency and this giant capex boom is going on. It's great, but the trade off is probably higher inflation. I think that's a relevant point to make, and that's without this energy crisis going on, which obviously adds to the problem. So I think we're far from getting back to like some 2% consistent inflation rate. The way to think about it is this large, globalized, hyper efficient supply chain system gave us 2% inflation. And the reality is just the global supply chains are breaking apart. Everybody wants more self sufficiency. The trend has reversed. And that's why 2% inflation is going to be difficult to achieve. So whether it's Russian energy or Iranian control of the Strait of Hormuz or whatever, inflation is going to remain elevated, in my opinion, because it's the globalization trend has reversed. Now, you can see over there at the end of this chart that investment in factories tapered off last year, right? Now, it's still 2.5 times what it was, in 2021. So we're still spending a lot of money on factory investment, but it shrank year over year. There's no question about that. I think part of that is maybe tariff related, right? It's just a little bit difficult to make a big factory investment if you don't know what's going to happen with trade policy. But honestly, guys, I think the vast majority of that decline that we're seeing here comes down to AI investment. I think AI has become this shiny new object that has just absorbed capital from like every other region, every other industry into itself because we're currently seeing an unprecedented amount of money being spent on data centers. And I really don't know another way to put it. What I did up on this chart, and I'm sure people have seen similar versions of this chart, but this is just the big five tech companies' CapEx spending. Okay. So in 2019, they spent about $76 billion combined. The CapEx has gone up 10x as of like this year. So, and you can see it's going up to over $1 trillion by 2029. So I wanted to put some of this, like, really just put like my macroeconomist hat on and talk about like historical comparisons versus the current spending we're seeing, and maybe talk a little bit about what these companies need to achieve to make this pay off. Okay, so you look like last year, $410 billion spent on AI data centers. That's about, adjusted for inflation and the size of the economy, what the United States spent on the intercontinental railway system during the 1800s. Okay, but we did it in 1 year. Now that is up over 50% again in 2026. $725 billion. Okay, we just had the Artemis mission, right? We're trying to go back to the moon in the United States. So we had the Apollo program before, right? 1960 to 1973, roughly. The US government during the space race with the Soviet Union spent combined and adjusted for inflation about $300 billion on the entire Apollo program from 1960 to 1973. We're shooting rockets into space. We're landing on the moon. We're coming home. We're doing all this research. We're investing in NASA. Okay, we're now spending over 2 Apollo programs per year on just AI data centers. Currently in 2026, we're spending twice as a percentage of GDP what we spent at the height of the last tech bubble on tech related capex. Okay, and it's obviously going up from here. You get to like $1 trillion. That's like what we spend on all residential housing in the United States annually. Okay, so the scale of this is again unprecedented. We've never seen private companies spend money like this. And so you add to this like the factory investment, the utilities investment to power the data centers, the infrastructure to and from the data centers and the factories, we are seeing a massive amount of physical plant and equipment investment in the United States, and it's absolutely been a tailwind for GDP the past couple of years. Back in the napkin math, I mean, we expect about 50% of GDP growth this year to be from just AI data center investment. Okay, so it's just undoubtedly been good for GDP growth, right? It's one of the reasons the economy's continued to grow. So all that being said, okay, these companies, if they're going to invest that much money, and it's about $4 trillion total, I want to say, by 2029, maybe a little over $4 trillion, just kind of looking at these numbers. Let's just call it 4 trillion by 2029. I think it's about 8 trillion by 2032 if you like really look out into the future. But just assuming 4 trillion, okay? Assuming like a 10% return on investment, these AI companies need to have about $400 billion in revenue by 2029. Okay? That's a 10% return on 4 trillion, right? 400 billion. So if you look at that, all right, so OpenAI and Anthropic today, they're about 80% of the AI market. They're pretty dominant. Combined have about $20 billion in revenue. So they need to 20x their revenue by 2029 is kind of the reality here. To make these investments pay off and keep this data center boom going. And personally, I think that's going to be very hard to pull off. $400 billion is the current revenue of the entire US software market. So like, let's say we're all worried about, hey, they're going to take over the SaaS, software as a service, and AI is going to write its own software and all this stuff. If AI took 100% market share from like Microsoft Office and Salesforce and TurboTax and everybody, that would get them to $400 billion a year, right? They need to take 100% market share. So it's a pretty daunting amount of revenue for them to make this all work. And I think that's the key here is like, can we actually see them generate a progressively larger and larger amount of revenue? Hard to know without the books being opened, but today it looks like they have about 20 billion. And the majority of that is from government contracts at like federal, state, and local level. Consumers and businesses are finding a hard, they're finding a hard time getting people to pay for this stuff. So all that said, there's no doubt, guys, this is the biggest CapEx boom probably since World War II in the United States. It's been a huge tailwind for GDP, okay? Business investment is about 15% of GDP. And that's why it's so astonishing that like it's going to be about 50% of GDP growth, right? It shows you how big the change is year over year that we're seeing in that business investment portion. Now, that being said, everybody's we're all in the financial services industry. We're kind of familiar with economic data, probably more so than the layman. Most people will know, okay, the US economy is really powered by consumers, right? It's about 70%, 65% consumer spending. So whatever happens to US consumers, that's what happens to like the rest of the economy, typically. That's like the rule of thumb or like the general idea. And so what's interesting is last year, as I mentioned, the job market stalled out entirely, but consumer spending remained strong. The economy grew. So what we've seen is the job market decouple from consumer spending. And before I sort of address that, I will say it's important to point out like this year the job market's bounced back pretty heartily. I think we're adding about 90,000 jobs a month through June versus like 9,000 a month in 2025. So about a 10x increase in job growth. That's awesome, right? But still, hey, we've got this situation where job growth and consumer spending have decoupled. So what's causing that? Okay, in my opinion, it's this chart right here. The demographics of consumer spending have changed dramatically in the United States, really in the past 5 years, but I guess you could even say back starting in like 2009, 2010, the great financial crisis. So as an economist, I was formally trained to look at people 30 to 54 because they're the biggest consumers. I'm sure most people have heard of this before. Like you've heard of the Harvey Dent indicator, right? And there's good theoretical justification for this historically, that this is when people are in their prime consumption years. They're starting families, they're buying houses, they're buying cars, they're buying furniture. They're doing all this consumption, right? Well, starting in 2022, they were no longer the biggest consumer demographic in the United States. As of 2022, the biggest consumer demographic in the US was people 65 and over. Okay. Retired people are basically powering the US economy for the first time ever. And guys, it's not hyperbolic to say like this has never happened in human history, right? Most human history, people didn't really live past 65. And in kind of more modern history, you retirement in general, the idea of retirement is like a new concept. But, you know, you retired and you're on like a fixed income or something, right? You're not like the biggest consumer demographic, surely. So, what's caused this? There's a lot of baby boomers. We all know that. But it's not just that, okay? There's actually more millennials than baby boomers alive today, and they are in the prime consumption years. So, it really should be them. So, it's not just like the actual number of baby boomers. What I think has done this is modern financial markets. Basically, over the past 30 years, when these people were saving and investing, uh, financial markets became democratized, right? Everybody now has seamless access to buy assets from anywhere in the world at the palm of their, at the tip of their fingers, the palm of their hand, right? Everybody's got a tax advantage savings account, a brokerage account, a 401k, free trades on your phone. And so it's been the biggest asset boom and the biggest ease of access to financial assets in world history while this demographic was saving and investing. And they've had more time in the market than anybody else, right? So there's a lot of directions you could kind of go with this chart. I think it also probably explains a lot of modern politics in certain ways. But my kind of big point I want to make on this call is retired people don't care about the labor market when they're making consumer spending decisions. They care about their financial asset values. Okay, so last year the job market stalls out, but the stock market was up 17 or 18% or whatever it was. So, of course, people were spending money because we have like this non-cyclical asset holder portion of consumer spending that really don't care about the job market. They care about their asset values. So, I think this situation combined with the biggest capex boom in like 30 plus years, probably like since World War II, that's what's been driving the US economy. And when we think about this year, listen, higher energy prices are going to slow things down. There's going to be a negative impact from this, but I don't think it stops people from visiting their grandchildren. And I don't think it stops tech companies from building data centers, frankly. And so I think we probably continue to see growth this year. Where I really kind of get concerned is it seems like all of our eggs are in one basket. Okay. I did mention the job market's broadened out. So there's some good things happening there. But broadly speaking, asset values are up because of optimism around AI and AI data center construction. Then you've got CapEx happening basically driven solely by AI, right? So what happens if the story around AI changes? That's what could reverse course here. Like in the past, it's been, hey, we're going to have a recession that causes the markets to decline. I almost think it could be opposite causation. The market declines and that causes a recession, right? So it's always been hard to do economic forecasting, and I'm not complaining. I love my job, and I feel blessed to be able to speak with everybody today. But it's always been an art and a science, right? And I want to emphasize, like, it's more of an art than a science than it's ever been, at least during my career. And so, hey, I think there's some reasons to be concerned. It's really that all of our eggs are in one basket, right? I'd much rather see more broad source of growth here. So I want to go ahead and wrap it up there. I've got a couple examples of the pieces we put out at First Trust on the screen here. Everything's one page or less. It's easy to read. It's easy to share. It's approved for use with the public. I think we currently have about 70,000 financial advisors signed up for this newsletter across the country. There's some great ways to sign up on the side of the screen. I've got my LinkedIn up there as well. If you want this, but you don't want it in your inbox, that's another good way to receive it. I'll always post everything we write on LinkedIn as well. So thank you guys so much again for having me. I'll wrap up prepared comments there. I know I touched on a lot, so let's feel free to fill in the gaps during Q&A.
Yeah, we got a few Bryce that already came in here, so I'm gonna go back and we don't need to bring things back on the screen. If you choose to in the end here, that's perfect. There was a two-part question that came of your last in terms of the spending aspect.
Yes.
Good couple of good pieces to this. It was actually a three-part question. First, it was talking about the 65 and older crowd, the retirees, and the two questions were: are they spending more on healthcare? Is that's what's factoring in? And two, are they borrowing more than they used to years ago for that group? And then the other question was in the opposite: why are millennials not spending the way that they were a decade or two ago, considering there should be more wages for them?
Yeah, great questions. So as far as healthcare spending, absolutely there's healthcare spending in there, and I think that is a big part of like what they're spending money on, right? People live longer, they're going to spend more money on healthcare, so that is a component, but it's not just driven by healthcare spending. I mean, there's a lot of discretionary spending in there as well, right? I'd say like primarily what's been driving growth is discretionary spending on all kinds of different things. As far as what was the second part of that question there? I apologize.
Are they borrowing?
Oh, borrowing. That's
Yeah.
right. So, um, listen, I mean, they're going out and borrowing money against assets. I'm sure they're getting mortgages for second houses and things of this nature. But so yes, you can lever your assets up, right, and borrow money against them. So
Yep.
there was probably some borrowing going on, but I think it's the paper wealth effect that's really causing people to spend money like this. Okay. When you see like your net worth go up 20% a year or something by just sitting around, you're going to feel a little bit more comfortable going on vacation or doing whatever else, right? So I think it's the paper asset gains that are, people feel more wealthy, they're spending more money. And by the way, the Federal Reserve essentially tried to do this on purpose, right? I don't know if we started talking about the Federal Reserve a little bit, but this was what Ben Bernanke and them would always talk about. It's like the wealth effect from low interest rates, right? We want to drive up asset values to make people feel richer, so we'll spend money and cause a recovery. And the chart that I showed, what's interesting about it is 0809 is when that demographic starts to rise. Now that's when a lot of them were retiring, but that's also when we started doing quantitative easing, right? We did $5 trillion of quantitative easing. Then we did COVID. We did another $5 trillion. When you pump all this money into financial asset markets, it makes asset prices go up, right? So I think there's been an explicit subsidy to asset holders basically over the past 15 or so years that's contributed as well. Okay. And then lastly, why are millennials not spending more money? Well, I think there's like a couple reasons, right? One is you look at like housing costs, okay, and that's a major political issue that everybody knows about, but housing costs is like a percentage of people's disposable income is just very high, right? So it's eating into other things you could spend money on. I think that would be probably the primary thing I'd mention, but childcare, like the other things that people talk about are all components. If you're going out and you're starting a family, it's very, very expensive relative to history to do that. It leaves you with less, I guess, excess spending power after you cover like the basic things to go out and compete with, I guess, baby boomers in retirement and the money they're spending, right? Their houses are paid off, their paper assets are going up 20% a year. They're just in a stronger financial position. So they feel more comfortable spending money, I think, and enjoying retirement.
Especially student loans too could be a factor, right?
Student
In terms
loans is
of, yeah,
another factor. Yeah,
yeah.
thank you for adding that one.
Yeah, no, for sure. And let's leave with this one because I think you've brought up, a number of things when you brought up the spending piece, and that, look, there's a lot of strength of these companies being able to do that. We've seen the strength in their returns in the markets, et cetera. The question was really, did you say that the CapEx, and make sure I do this correctly to the person's question, CapEx was more than the tech bubble, inferring the question is, are you reading that in? Are we in a more serious bubble than the tech bubble, based on the amount that these companies are spending on AI?
Yeah, great question. So, in like sheer like the size of spending that's happening, we're today like over twice the percent of GDP that we were at the height of the tech bubble when it
Yeah.
burst last time, right? So we're already way bigger, and it's gonna like what, like almost go up 50% from here, right?
Yep.
So the scale of it is much, much, much larger. So that's just objectively the case.
Yep.
Now there is a difference though, which I think is worth pointing out. One, these companies have a lot of earnings. Okay. So they're not pets.com. Like Microsoft prints money. They're very
Yeah.
profitable. So that's why they can afford to do this. They're also borrowing a lot of money now, though. So they're taking on some balance sheet risk. A lot of this, by the way, is hidden through like clever accounting mechanisms, right? They don't technically own the data centers. They're all like off balance sheet vehicles that they sort of, so they're playing games, right? A lot of the revenues are just circular. Okay, so
Yeah.
like 50% of Microsoft's AI revenue is actually owed to them by OpenAI because they paid the money to OpenAI, right? So it's another one of these like circular things. So that's sort of similar to the tech bubble. The last thing I'd mention though is like I think, and maybe this is more similar to the tech bubble than it is like 0809, but this seems more ring fenced off from the real economy than like 0809 was. Because right now it seems like private credit, like a lot of private market deals have really financed a lot of this stuff. Those are the people that I think are the most exposed if this whole thing comes to a screeching halt, right? So listen, our semiconductor stock's going to go down. Yeah, is like Caterpillar stock going to be where it's at today? If data center construction goes down, probably not, right? But I think the worst damage is probably to like private investors or accredited people that can afford it, right?
Yeah.
Rather than like Main Street. So it's I think it will be quite different than the 0809 financial crisis if it does come to an end, which I just don't know how it's sustainable to spend this much money on data centers when they're not generating revenue and frankly, they just don't have products to really sell, right? I mean, they have chat bots, but individuals don't want to pay for it. Businesses would rather just use Chinese models that cost 1/10 the price. Really, it's like government paying them for like defense applications or surveillance, and then local governments paying for like flock cameras. That's like what we have going into these data centers right now, from what I can tell. That's the vast majority of their revenue.
Yep. Those are great. Look, I wish we did have more time the way we started this discussion. We gave you 30 minutes to cover a lot of topics. Some of the questions involve government intervention and AI. So we got lots to talk about on another call. Love to have you back on in the future, virtually in person. We'll see what would fit in the future, but we
Yeah.
really appreciate your time today. Thank you for being the anchor of day two of the Advisor Network Virtual Connect 26. For everybody who's been a part of the last couple of days, thank you. It's been exhausting, but it's also at the same time been incredible to share so many institutional perspectives, so many advisor to advisor interactions. And that's kind of the ethos of this network. So, to the 7,000 folks who have made this what it is, thank you. And we're excited for where we're going from here. So, Bryce, thanks again. Have a great rest of your day.
Yeah. Thanks, Colin. I appreciate it.
All right. Be well, everyone.